Thank you, Gaurav, and to all the panelists. Now moving ahead, our speaker, Mr. Adam Kent, Managing Director of Maritime Strategies International. Adam is going to give a presentation on the 4 E's, fundamental market developments. Adam, please. You can explain the 4 E's.
Thanks, Kevin, and it's great to be back and see so many in person. It's not quite the same doing on a Zoom call or on MS Teams. So, as Kevin says, I'm going to be covering the E's today, and I've actually had to shoehorn a few more in, given recent events. What I hope to do today is just to give you an overview of our current outlook on the markets. I also want to bring you up to date on a few developments that we've recently introduced at MSI. The first thing I thought I'd do was just take a very quick health check on the markets. I think it's safe to say that in general, shipping has performed exceptionally well over the course of the last 2 years, even though there's been a global pandemic as a backdrop. And here we can simply see just trade growth year-on-year changes across the main shipping sectors. Now, yes, 2020 was a problematic year for some sectors, as we can see by the yellow bars, but in general, cargo has bounced back above and beyond the deficit that we saw in 2020. As you can see from the numbers in the orange boxes, it's only crude so far that hasn't backfilled the hole that COVID has left. On the fleet side, I think this is best termed as manageable. That's the way I've termed it on the slide. We haven't seen any double-digit growth, and in lots of instances we've seen single-digit growth, and we're going into a period of, for some sectors at least, low cargo growth rates. So where are we sitting on the earnings cycle? Well, I've resurrected a conference favourite slide here, but you'll also notice I've made a slight addition to this slide. Container industry is booming. Who would have thought we needed global GDP growth of -3% and a global pandemic to drive container ship rates up to all record highs? Dry bulk, VLGCs have also been very strong. We think they're coming off the recent highs. And you can see across the rest of shipping, that's all on an upward trajectory in terms of our earning forecast, with the wet sectors in the foothills, oil tankers, chemical tankers, and I'm going to class offshore in there too. And at the top of the cycle, we're seeing sort of MPPs and RoRos. Not only have they had their own strong fundamentals, but they've ridden on the coattails of the container ship industry as well. Now, for those of you that noticed the container ship growth rate on the first slide in 2021, that was around 7.5%. Supply around 5% last year. A net position of 2.5% doesn't lead to record earnings, and Panamax, traditional Panamax is earning $200,000 a day. Where we've really seen this industry being given a leg up is through the inefficiencies and the lack of productivity when it comes to looking at individual ships. Now, this has come through port congestion, route deviation, quarantining, etc. And what I want to do is just focus in on port congestion to start off with. Here we see a chart on the left which highlights container port congestion expressed against the average from 2016 to 2019. And you can see in some months, in some instances in 2021, we saw some months port congestion over 1 million TEU above and beyond the historical average. Yes, it's come down a little bit, but events in Europe and events in China have pushed this congestion back up again. The chart on the right-hand side, that shows our dry bulk, MSI dry bulk port congestion index. And if you look at it on the trend basis, since 2020, we've seen month-on-month increases in port congestion for dry bulk. We can try and quantify that, and that's what we try and do at MSI. What I've done on here on this slide is look at the difference between trade, ton miles, and taken it all the way to shipping demand. Ton miles will only tell you part of the story, and I think that's an important part, and that's certainly what we've seen in the industry very recently. If we focus in on the oil tanker chart on the left, we can see trade was around minus 7.5% in 2020, ton miles around minus 7%. But actually, in terms of shipping demand, how many ships you need to service global trade on the oil side, that was actually, admittedly only just, but that was a positive number. And that's because all the inefficiencies, ships weren't moving as quick, ships were taking longer to get to their destination, ships were being used for storage. If we look across on dry bulk, what we can see here, if we look at 2022, we can see positive trade, positive ton mile, and actually we think we'll see negative shipping demand in 2022 for dry bulk because some of the inefficiencies are starting to unwind across that side of the industry. And what I've then gone and done, just to further re-emphasize this point, is utilizing the MSI Horizon system, whereby us and our clients can start playing around with some of the underlying efficiencies within the system, both on the oil, dry, containers, etc. I've conducted a scenario whereby I say, well, in 2022, in 2023, what would happen if port waiting times and congestion went back to 2019 levels? And I've compared that against our base case one-year TC rate. Here we can see for tankers, what you're looking at is a reduction in our base case TC rate of down to around 14-15%, where we're currently forecasting our base case one-year TC rate. Where it really hits home is if you look at dry bulk. If you just look at that Cape-size number, if we saw port congestion reverting to 2019 normals, we'd expect to see Cape-size TC rates 40% below where we're currently forecasting. That's how important inefficiencies and fleet productivity are to today's markets. Now, it would be remiss of me to stand up here and talk about the markets and not mention the Ukrainian invasion. I think what I'm going to do is just outline very quickly some of the short and the longer term impacts we think the invasion will have on shipping. If we start off on dry bulk, Ukraine, Russia are responsible for about 7.5% of all global dry bulk trade. Where the impact will be most hardly felt is in the grains and the coal side. And in the short term, this will be good for ton miles. We expect to see more coal being transported from places like Australia, Colombia to Europe. On the grain side, we expect to see more grains coming out of the Americas heading east. In the longer term, it could be a net negative. We're already concerned about food security and the yields and the harvesting volumes that we're expecting to see over the next 2 years. Some of that is being driven by the lack of fertilizers or the price of fertilizers. And on the coal side, as we see coal prices continue to remain high, we expect to see places like China and India sort of tapping into domestic reserves a lot more than shipping in cheaper, internationally sourced coal. Oil, on the right-hand side, well, around 25 to 35%, depending on the year, of European oil comes from Russia. We expect to see more of that oil heading east. We expect the deficit to be fed from the Middle Eastern barrels coming to Europe and potentially US barrels. If we move on to containers, for containers, it's about a net negative. Russia, Ukraine are responsible for about 1.5% of all global container box lifts, and in Europe around 5%. Only Costco are the major liner companies that are currently calling into Russia. I think where the container ship industry could suffer in the longer term is this inflationary pressure and the lack of consumer confidence that will impact consumer spending on containerized and manufactured goods. Gas, again, about 30% of European gas is piped in from Russia. Around 3% comes in via ships. We expect to see, again, a switch from LNG coming from Russia and going to the east, whereas a lot more US gas will come from, obviously, the US or head to Europe, and that will, one will be a positive for ton miles and one will be a net negative for ton miles. And some of the specialized cargoes will also see huge impacts. Russia and Ukraine are responsible for 80% of global sunflower oil exports, a huge percentage. That will obviously have impacts on sunflower oil shipping, but also other edible oils as the global economy looks for alternatives to sunflower oil in the other edible oil markets. Russia and Ukraine are responsible for about 15 to 20% of all global ammonia exports. And as I've said, there is already a problem with fertilizer prices and a shortage of fertilizer, and that is a huge concern for sort of food scarcity and food security globally. Now, what we can do is then look at how this is going to impact our forecast. And in our base case at the minute at MSI, we're hoping that there'll be some resolution to the current conflict in the second half of this year. And you can see here from our view of oil being exported out the Black Sea and the Baltic to Europe, we expect to see a dip in 2022, but we expect to see some return to pre-invasion levels in 2023, but we're not going to get back to the same sorts of levels that we saw pre-invasion. On the LNG side, what we can see is this, as I mentioned, a firm shift from Russian LNG moving east, and that will be displaced by things like US shale gas. Now, these events and these new dynamics that we're seeing in the industry are playing into our new energy model. MSI now has an energy model which looks at the energy transition and the energy landscape out to 2050. Here we're explicitly forecasting energy use by things like transport demand, electricity generation, and where it really comes home to the shipping community is the production, the consumption of these energy sources, and what that ultimately means for bilateral trade and the requirements for shipping. I've just taken coal as an example. It's one that is often talked about, and I just wanted to put some numbers in and around coal. Here we can see on the left-hand side coal imports by destination. We can see that Europe has already peaked out. We think that China's peaked out in terms of its coal imports. We still think there's quite a bit of runway in India, and we don't expect to see coal imports peak in India until around 2035, but then tail off shortly thereafter. On the right-hand side, we can see the red line, which is our forecast for total coal demand globally, but then where we expect to see shipping requirements. And as you see, towards the sort of middle of the century, we expect to see more coal being transported on smaller vessels, which will typically mean shorter volumes from places like Indonesia to Southeast Asia. So a really important tool trying to understand how the energy transition will ultimately impact shipping. Now, it's not only the energy demand and the energy transition that we expect to see change a lot in the coming years. We also expect to see the fleet transition quite a bit over the coming years. And we're actually forecasting some very healthy scrapping numbers in our current base case forecast. That's primarily driven by simple things like the age profile of the fleet, the level of contracting that we've seen certainly last year in things like the container ship and the gas markets. We expect to see bunker prices remain relatively high, scrap prices high, and then of course we have the regulatory pressure from people like the IMO, the EU, and we have, as we've heard about today, Poseidon Principles, Sea Cargo Charter, and the Poseidon Principles from the insurance community. And what we've started to do a lot more at MSI is really start to try and drill in what this means for both the industry, for sectors, but also for individual ships. And here you can see some sort of cohort analysis that we've been doing at MSI using our analysis, looking at the impact that positioning individual vessels on a CII trajectory, aligning that with where we expect to see it on Poseidon, and then drilling really down into the Poseidon Principles to see which vessels will comply based on our estimates versus those that currently don't comply. And we've added a new element to our MSI FMV product, which is our environmental credentials element. Here we are now estimating AER for 2020 and 2021, the vessels Poseidon Principles trajectory alignment, and also a 0 by 2050 alignment, We also have the CII and how that we think will develop over the next 4 years, the EEXI compliance, and as you can see, you can present this in a simple graphical format. And not only are we doing it on an individual vessel basis, we're also working that out to fleets and portfolios, so you can see where your portfolio sits in alignment with the trajectories that I've already spoken about, export it into Excel, fill in DCS data that you know, or your outstanding debt on certain assets to really see where your portfolio sits in line with the trajectories. What we've also done is started a partnership with BMT. BMT are a globally renowned design and technical consultancy that are able to drill in the details of individual assets to a level that's beyond what we're doing at MSI from an econometric perspective. They're able to do it from a technical perspective. And they're able to help us look at things like engine power limitation, what that means for individual assets, what that means for the trading profile of that asset, and then the productivity. As I say, productivity of assets has been key over the course of the last couple of years. Now, if a vessel doesn't align with EEXI, then you need to look at alternative solutions. And one thing that we're able to do with BMT is look at energy-saving technology solutions to see what vessels you could apply these ESTs to, what sorts of savings from a fuel and emission perspective you can ultimately achieve. And in this instance, what we've done is we've looked at an asset. This is an Ultramax bulker, and it's been identified as a good vessel to fit a propeller duct on. And what you're able to do then is you can either bring the vessel down to meet the EEXI and the AER trajectory, but also, once you've fitted these EST technologies, you can also speed that vessel up and still align with your EEXR and the AER trajectories. And this instance, if you were, the global rate of transatlantic on an Ultramax of $25 per ton, that would equate to around $2.5 million you would be able to achieve by doing extra routes and extra trades operating at slightly faster speed. And just to culminate with the last two slides, as I said, efficiency has been very important over the last 2 years. When markets are good, obviously the more you can trade, the more you can potentially earn. But also when markets are bad, if you're more efficient, you're going to be at the front of the line when it comes to employment. And this is our sort of overview of where we expect to see earnings over the course of the next few years. The box and whiskers plots just show the distribution of historical earnings since 1995. The red dots show where current earnings are, and the green dots show where we expect to see earnings come 2024 on an annual average basis. For the tanker sector, we expect to see improvements. For the dry sectors and containers, we expect to see earnings come off, which probably isn't a surprise given where container rates are today. And then finally, as I always try to do at a conference presentation, is try and look at it from an investment perspective. We are at Marine Money after all, and we are in a period of uncertainty, but are there still positive investments to be made in shipping? And in this exercise, what I've done is assume that you go out today and you buy a 10-year-old, and then you sell that vessel in 2026. What sort of returns can you get from buying and selling, and for the cash flow in between? And you can see that all of the double-digit IRR returns are from the wet sectors, tankers, chemical, some LPG, but also car carriers. Where we do expect to see some negative IRRs over this period if you're buying at today's prices or on the container sector. Thank you, everyone, for listening, and I'll be around all day if anyone has any questions.
Thank you, Adam. We're going to have a break now for about 25 minutes, so we'll reconvene at about 10 to 12, please. Thank you.